Every market moves through a series of impulsive and corrective moves, but the question is, how can we estimate where a correction is likely to end and enter a long trade early? What if I told you there is a specific tool that helps with this, one used by many professional traders to identify potential trading opportunities every day? That tool is the Fibonacci retracement levels. In this video, we are going to provide the most advanced explanation of how to use Fibonacci in trading, one you can't even find in paid courses. Additionally, we'll introduce two of the most effective trading strategies that use this tool in combination with price action and smart money concepts. So if that's something you're interested in, make sure to hit the like button to support our work and subscribe to our channel if you're new. See you after the intro. To understand how to use Fibonacci, we first need to understand how markets move. Price moves in waves because of the behavior of market participants. When there is strong buying interest, the price moves higher. Eventually, the price reaches a level where some traders and investors believe it is high enough to sell, causing a pullback. If the buying interest remains strong, many traders see this pullback as an opportunity to enter long positions. Then, the market continues to move higher again. This pattern continues until the overall market sentiment changes. Impulsive moves push the price strongly in one direction. They are made up of large, same-colored candles with strong momentum. On the other hand, pullbacks are temporary corrections that show indecision in the market. They often consist of mixed-colored candles with smaller bodies and noticeable wicks. But not all pullbacks are equal. Sometimes, when the buying interest is strong, the market only retraces a small portion of the previous move. At other times, the market pulls back much deeper before continuing its upward trend. A small pullback usually indicates a strong trend, while a deep pullback suggests a weak trend. Typically, trends start strong and gradually weaken. Eventually, they reverse. Now, with all that said, identifying where a pullback is likely to end and where the next impulsive move may begin is highly profitable. It helps us find potential buying or selling opportunities in the market and ride on the trend. But how can we estimate where the pullback is likely to end? This is where the Fibonacci retracement tool comes into play. The Fibonacci sequence is a series of numbers where each number is the sum of the previous two numbers. When you divide certain Fibonacci numbers, you get these magical ratios. These ratios appear surprisingly often in nature. Now, what does this have to do with trading? These patterns often appear in nature because they are efficient ways for structures to grow and organize themselves. Many traders believe similar patterns can also be found in market behavior. That's why Fibonacci percentages are used to measure how much of an impulsive move has been retraced before the trend continues. Now, why do Fibonacci levels work in trading? The main reason is not necessarily because markets are governed by nature. It's often because many traders watch the same levels. Large numbers of buy and sell orders gather around them. Price reacts because people expect it to react. This is called a self-fulfilling prophecy. Now, before getting into how to use Fibonacci levels in trading, let me show you how to set up the Fibonacci tool correctly on the TradingView chart. To access the Fibonacci retracement tool, click on the arrow beside the Gann and Fibonacci tools on the left toolbar and select Fib Retracement. Click once on the chart, drag it upward and to the right, and click again to lock it in place. Now, let's change the appearance to make it more effective to use. Double-click on it to open the Settings tab. Remove the levels that go beyond 1, as well as the 23.6% level, because we don't use them in our trading strategies. Give the 78.6% and 61.8% levels a green color as a reminder that these are the most important levels we will constantly use in our trading, and set the rest of the levels to black. Now that we're all set, it's time to use the retracement tool in trading analysis. We always apply this tool from the start of an impulsive move to its end. In this example, the latest impulsive move started at point A and extended all the way to point B. So we apply the retracement tool from A to B. Now, here's an important question. How do we know this point is the end of the impulsive move? The answer is simple. We don't. If the price keeps moving higher, we simply adjust the Fibonacci tool to match the latest move until a correction begins. The purpose of this tool is not to predict the exact top. Its purpose is to measure the correction and identify where the pullback may end, so we can find potential trade entries. But which Fibonacci levels are best for trading? Let's look at some important concepts. First, if a pullback does not reach the 38.2% level, we consider it market noise rather than a valid correction. So in this example, we treat the move as a single leg and adjust the Fibonacci tool again. Second, in strong trending markets, pullbacks are usually shallow and often fall between the 38.2% and 50% levels. However, this area is generally not ideal for taking trades. The reason is simple. Wherever we enter a long position in this zone, our first target is the previous market structure high. Since price has recently reached this level, there is a higher probability that it will test it again before a reversal takes place. At the same time, the safest place for our stop loss is below this low. The closer our stop loss is to this low, the safer the trade becomes. As a result, entering within this zone often gives us a poor risk-to-reward ratio, and it's simply not worth the risk. We want our risk to be small and our potential reward to be much larger. This is also a good time to mention an important smart money concepts principle. The area above the 50% level is called the premium zone. The area below the 50% level is called the discount zone. The idea is simple. Buy at a discount in an uptrend. Sell at a premium in a downtrend. Now let's move into the deeper levels. The 61.8% level is called the golden ratio, and the area between the 50% and 61.8% levels is called the golden zone. This area is popular because the price often reacts to it and continues in the direction of the trend. And finally, we have the 78.6% level. This level usually offers the best risk-to-reward ratio. Your stop loss can remain relatively small while your profit target stays the same. However, there is a downside. You may miss many winning trades. In many cases, the price never reaches the 78.6% level before reversing and continuing the trend. Now that we've covered the key concepts behind Fibonacci levels, it's time to look at a practical trading strategy with clear entry and exit rules. The first strategy is a simple yet powerful trend continuation setup that combines market structure with Fibonacci retracement levels. Open any chart on TradingView. Step 1. Identify the trend by marking the impulsive and corrective moves. If you cannot clearly identify a trend and the market looks choppy, simply close the chart and look for another pair. This strategy works best in trending markets. If the market is in an uptrend, we only look for buying opportunities. If the market is in a downtrend, we only look for selling opportunities. Step 2. Identify the most recent impulsive move and apply the retracement tool from the start of the move to the end. Next, place a buy limit order at the midpoint between the 61.8% and 78.6% levels. Place your stop loss below the recent swing low. Once the price reaches the first target, close half of the position and move your stop loss to break even. This makes the remaining trade risk-free. The logic behind this setup is simple. Deep pullbacks are very common in trending markets. By entering within the 61.8% to 78.6% retracement zone, we enter earlier at a good price. The stop loss is placed below the recent swing low because a break below that level would invalidate the uptrend. The first profit target is conservative and has a high probability of being reached, allowing us to secure profits while giving the rest of the trade room to continue. The second take profit target is the next important level ahead of the price on a higher time frame. However, before entering a trade, we need to make sure the price has enough room to move. If you switch to a higher time frame and see that the price is already inside or very close to a higher time frame supply zone, that zone can cause a reversal and stop us out. That's why we only take trades when there is enough distance between our entry and the nearest higher time frame supply or demand zone. Now, you might say that this is too simple to work, but remember, more confirmation doesn't mean a safer trade. It usually means you're already too late. Now let's look at a real chart example. Here we have gold on the 1-hour chart. The market was in a downtrend, but the latest move failed to create a new lower low and then broke above the previous market structure. This suggests that the market direction has turned bullish, so we can start looking for buying opportunities. Here is the start, and here is the end of the most recent impulsive move. We can now apply the Fibonacci retracement tool to measure the potential pullback. We expect that the price will retrace, find support somewhere within this range, and then continue higher. However, as our strategy suggests, we will use a conservative entry. We place a buy limit order between the 61.8% and 78.6% levels. The stop loss goes below the swing low. The first take profit target is placed a few pips below the recent high, while the longer-term target can be the next major turning point in the market. Now let's play the price forward. As you can see, the trade reaches our target and results in a winning trade. Price then makes another impulsive move, breaking market structure to the upside once again. This gives us another opportunity to apply the Fibonacci retracement tool and place a new buy limit order. Let's move the chart forward one more time. This time, the price didn't reach the 61.8% level, so our order is not triggered. That's perfectly fine. Not every setup will lead to a trade. We simply wait for the next opportunity. We can continue trading this strategy as long as the market remains bullish. We stop looking for buy setups when the price reaches an important higher time frame level or starts showing signs of a trend reversal. It's also important to understand that retracement levels can also be combined with other trading concepts to create different types of entries. In the next section, I'll show you a powerful strategy that combines Fibonacci levels with price action concepts. Strategy number 2. To begin, we need to identify a major market structure level. This level will serve as our key point of interest and the area where we will look for potential trading opportunities. But what is a major market structure level? A major market structure level is an area where price has been rejected multiple times, has acted as both support and resistance, and has been respected recently. These levels are extremely important because they often provide some of the highest probability trade entries. Here, we have a major market structure level. If the price retraces back to this zone, we can anticipate another rejection to the upside. However, we are not going to enter a trade based solely on this level. We need additional confirmation that buyers are stepping in and that the level is likely to hold. So let's zoom in on one time frame lower to find that confirmation and look for an entry. On the lower time frame, the confirmation we are looking for is the formation of a double bottom rejection pattern. Double bottoms and double tops are powerful reversal patterns. When a double bottom forms at a key demand level, it signals a potential bullish reversal. Likewise, when a double top forms at a key supply level, it signals a potential bearish reversal. This is because price has tested the level twice and failed to break through it, indicating that buyers or sellers are defending the area. However, we should not enter the trade immediately. We must wait for the price to break through the neckline to confirm the double bottom pattern. Once the breakout is confirmed, we can enter the trade with much greater confidence. Now, in this example, we have a double bottom pattern forming at a higher time frame demand zone, which signals a potential buying opportunity. However, at this point, we are already too late to enter the trade. No matter where we place our buy order right now, the stop loss would still need to be positioned below the swing low to protect the trade from normal market fluctuations. This would result in a very large stop loss and a poor risk-to-reward ratio. Instead of chasing the market, we need to wait for a pullback that allows us to enter at a better price. This is where Fibonacci retracement levels become useful. By applying the Fibonacci tool to the latest impulsive move, we can identify potential support levels where the pullback may end. According to our strategy, We place a buy limit order at the 61.8% Fibonacci level. If price retraces into this area and finds support, our order will be triggered, and we will enter the trade at a much more favorable price. Now let's look at a real chart example. Here we have euro-dollar on the 1-hour chart. If I draw a zone in an area, you can see that price has repeatedly reacted to it as both support and resistance. This tells us that it is a major market structure level that market participants are paying attention to. Recently, the price broke below this level and then pulled back into it. Based on this behavior, we expect that the level will now act as resistance and that the price may continue moving lower. However, before entering a trade, we want additional confirmation that sellers are actually stepping into the market. To do that, we can zoom into a lower time frame and study the price action more closely. Let's move to the 5-minute chart. On the 5-minute chart, we can see that the price has formed a double top pattern, which is an early sign of a potential reversal. However, the pattern is not confirmed yet. To validate the setup, we need to see the price break below the neckline. If the price continues pushing higher and the neckline break never occurs, then there is no trade. So let's play the chart forward. As you can see, price breaks below the neckline, confirming the pattern and increasing the probability of a move to the downside. Even so, we still don't want to enter the trade immediately because the stop loss would be too large. Instead, we should wait for a pullback. We apply the retracement tool to the most recent bearish impulse and place a sell limit order at the 61.8% Fibonacci level. The stop loss is placed above the swing high, and we're going to target the next important level ahead. As you can see, Fibonacci retracement levels are a simple but powerful tool for improving your trade entries. Instead of chasing the market after a move has already happened, they allow you to patiently wait for the price to come back to you and offer a more favorable risk-to-reward opportunity. If you found this video helpful, make sure to leave a like and subscribe to the channel for more trading strategies and market education. Thanks for watching, and I'll see you in the next video.